Okay, so good morning. So today I want us to go to the next topic, and today we will be discussing a topic by the title Impairment of Asset, and this is normally guided by IAS number 36. So by the end of this class, so these are the expected outcome. Number one, you should be able to explain the concept of asset impairment and the objective of IAS 36. You should be able to identify indicators of impairment for different classes of asset in accordance with IAS 36. You should be able to compute coverable amount of asset and determine impairment loss used to work examples. You should be able to prepare and present appropriate journal entries and financial statement disclosures relating to impairment of asset in line with FRS requirement. So let's go to the introduction. So IAS 36 impairment of asset prescribe the procedure an entity should apply to ensure that assets are carried at no more than their recoverable amount. An asset is impaired when its carrying amount exceeds its recoverable amount. The purpose of IAS 36 is to ensure assets are not overstated on the statement of financial position. So there are some few terms that we have used in this slide, which I want to explain using this slide, the key definition. Carrying amount. The carrying amount at which an asset is recognized in the financial statement after deducting accumulated depreciation and accumulated impairment loss. So the carrying amount, in short, we say it is the cost of an asset you minus the accumulated depreciation. Remember, an asset, we normally depreciate an asset on monthly basis. So that monthly basis accumulates, to form the accumulated depreciation, which is posted in the balance sheet. Then you have the recoverable amount. So the recoverable amount, it is the higher of the fair value less cost of disposal or its value in use. So the fair value less cost of disposal, this is the amount obtained from selling an asset in an arm's length transaction between knowledgeable willing parties, less the cost of disposal. So we normally say the fair value, for example, if you go to the market and you want to buy a laptop, what cost can you buy a laptop? So you can be told this laptop, it will cost 10,000, but the disposal will be 2,000. So the cost of the laptop will be 8 million. Value in use, the present value of future cash flow expected to be derived from an asset, continued use, and its disposal at the end of its useful life. So let's say you have bought a matatu. So this matatu, the value in use, it is now, that matatu, let's say it can generate 5 million in 3-year time. So how much is 5 million worth today? That is what we call the value in the present value. So you're going to get that amount the bus can generate in 3 years today. Impairment loss, the amount by which the carrying amount of an asset exceed its recoverable amount. So remember we have said the recoverable amount, it is the higher of the asset fair value, where we have said the fair value is what the asset can be sold out there in the market. If you find a motor vehicle being sold, you can say this motor vehicle, it is valued at 5 million. Value in use, we have said it is what the asset will generate, let's say in 5 years, that amount today. Okay. So how can you know an asset is impaired? What are the indicators of impairment? So the indicators of, these are the signals, yeah, which company should use to assess the impairment. So this can be classified into two. There can be either external or internal sources. According to IAS 36, the presence of any of these indicators require an entity to perform an impairment test. So an organization should perform an impairment test when these indicators are present. So which indicators are these? Let us first of all look at the external sources of information for impairment. Number one, it is decline in market value. A significant or prolonged decline in the market value of an asset or group of an asset indicates impairment. Example, the market price of a piece of machinery has dropped due to technological advancement, making it worth less than its carrying value. I want to give an example. Let's say we have a printing machine, or the photocopier. So today we have photocopier which are wireless. So you don't require cables to connect. So if you have a printer which uses cable, and now that has been overtaken by the technology, we have now printers which are wireless. That means that asset is already impaired because its market value has declined. Or today we are talking about moving from the petroleum-driven machine to the electrical machine. So by the time we will have so many vehicles using electricity as opposed to the diesel or the petrol, so you find those machines, the motor vehicle using the petrol or diesel, we have declined in value. The other one is adverse changes in economic, technological, or legal environment. For example, unfavorable changes such as new competitor entering the market, regulatory changes, or legal ruling that negatively affect the asset value. An example, a change in environmental regulation that make company equipment or process obsolete or less efficient. For example, you find that these days the government is advocating for machines that pollute the environment less and less. So that means the conversation about the climate change is on top gear. So you find that some of the machines that are used in the factory are going to be ruled out by the companies or by the regulator. So that way you find that by the virtue of the technology or legal environment, that the companies which are using those machines are going to be affected. Obsolescence or reduction in demand. So technological advancement, market condition, or customer performance may result in asset becoming obsolete or losing value. So you find that some asset may lose value because of the technology. So an asset maybe that was used before, right now it cannot be used because it has been overtaken by the technology. You remember, initially we are using the analog TV. Today, we are using the digital TV. So those assets, whoever owned that asset, or the company which used to manufacture those analog TV became obsolete. Negative changes in the market condition. So we can have a significant downturn in the market or sector where the asset operate may indicate a reduction in recoverable amount. Example, a sudden collapse in demand for particular good, reducing the production value of associated manufacturing equipment. For example, negative change in the market. Some time back, for example, for women, they used to have this innerwear called the popularly known as kamisi. So I mean that now has been overtaken by event because I don't think that kind of a dress is being worn today. So the company that used to manufacture those kind of the innerwear, they no longer exist. So then we have the internal sources of information for impairment. One is physical damage or deterioration of the asset. So evidence of physical damage or wear and tear beyond what was originally expected could indicate that the asset future economic benefit are reduced. Example, machinery in a factory break down more often than anticipated, leading to higher maintenance cost and reduced efficiency. Then we have poor performance of the asset. If an asset or a cash generating unit is underperforming compared to initial expectation, this could indicate impairment. An example, a retail store consistently generates lower than expected revenue, indicating the possibility of a lower recoverable amount. So if you look at these two points, they are almost the same. Physical damage, if you have an asset in a manufacturing concern and that asset is physically damaged, so that means it is breaking down, like for example, I know sometimes back we used to go to the maize milling machine, the portion mill. And sometimes you could find that the portion mill has broken down, so people cannot, get the uga. For poor performing, so you find that an asset could maybe, for example, let's say the same flour mill, the commercial flour mill, they produce 100 barrels per day. So the machine now is producing 50 barrels per day. So that means the asset is not performing at its optimal levels. Then we have plan to discontinue or restructuring operations. So the decision to close or restructure part of a business that utilize certain asset may indicate that the asset are impaired. Example, a company decides to shut down a particular product line, making the equipment used for that line obsolete. So sometimes the company, so there is decision which you call buy buy or make decision. So if a company do the analysis and find that it is simpler for them to buy instead of making a particular product, then the machine that was used in that production became obsolete. Then we have changes in use of the asset. If the manner in which an asset is used changes significantly, this may be an indicator of impairment. Example, a factory reduces production volume, which could affect the economic benefit derived from the machinery. Then we have significant decline in economic performance. So when the cash flow or profitability from an asset or a CGU are lower than originally forecasted, it may indicate impairment. Example, a hotel see a sharp drop in occupancy rate due to changes in the local economy, impacting revenue generated from the property. And this actually, it is a paradigm shift today, because most of the hotel, let's say for example Mombasa, they are very expensive. So you say that most of people, instead of going to hotel, they normally go to Airbnb. So this has negatively affected the hotel business in terms of accommodation. So let us look at the accounting for impairment. So the impairment loss is charged to the P&L or the profit and loss statement. After recognizing impairment, the carrying amount of the asset is reduced to its recoverable amount. For non-revalued asset, the impairment loss is directly recorded in the P&L. For revalued asset, it is treated as a reduction in the revaluation reserve. So we are going to see those statements in practice in the next few slides. So what happened when an asset have or an impairment have reversed? So you have talked about decline in market value, poor performance, physical damage, all that. So what happened when those conditions have changed? So if there are favorable changes in the estimate used to determine the recoverable amount, the impairment loss may be reversed in the subsequent period, but only to the extent that it restores the asset carrying amount to what it would have been without the impairment loss. So you cannot uh, revalue the asset past what the asset would have been. That is the carrying amount. So remember, we say that the carrying amount, it is cost minus accumulated depreciation. So if the cost minus accumulated depreciation is 5,000, so then if for example the asset had been impaired 2,000, so you cannot restore the asset past the 5,000. So these are the general entry. So if you impair the asset, you debit the income statement with the impaired amount, then you need to credit the impaired asset that is in the balance sheet. So if when the impairment is charged to the revaluation reserve, so debit the revaluation account and credit the impairment asset. So you can either use these two treatments here. An example, a company owns a factory building with a carrying amount of 1 million. Due to a natural disaster, part of the building was damaged. The company estimates that the recoverable amount of the building is 750 based on the future cash flows expected from its use and the potential sale value. So this is what we call value in use. So you are required calculate the impairment loss, if any. So the impairment loss, we have said it is the difference between the carrying amount and the recoverable amount. So we are given the carrying amount of 1 million. So remember we said the carrying amount, this is the cost minus accumulated depreciation. Then the recoverable amount, so remember we said the recoverable amount, it is a higher of value in use and the fair value. So here we have already been given the value in use. So the impairment loss would be 1 million minus 750 to give you 250. The journal entry here, you debit the impairment loss, that is in the income statement, 250, and credit the building. This is the balance sheet. So you credit the revalued or the impaired asset. Okay, so let's move on. Example 2. A company owns a vehicle that had impairment loss of $20,000 recognized in the previous year, reducing the carrying amount to $50,000. In the current year, market conditions have improved, and the recoverable amount of the vehicle is now estimated at $65,000. The required calculate the impairment loss, if any. So solution here, you need to debit. So if you look at this, the impairment has reversed now. Yeah. So here you debit the balance sheet. Yeah. And then you credit the impairment reversal. This is in the income statement, because the asset, if you look at this question again, in the current year, the market condition has improved and the recoverable amount of the vehicle is 65. So it is 65 minus 50, which give you 15. So 15 will be the amount that you are going to, it is the reversal of the impairment. Example 3, ABC Limited purchased a piece of machinery on 1st January 2021 for shillings $500,000. So the company uses straight line depreciation over 10 years with no residual value. On December 31st, 2023, due to a decline in the market demand for the product produced by the machine, the company suspects the machine may be impaired. So the company performed an impairment test and gathered the following information. Fair value less cost to sell of the machinery is estimated to be $200,000. The value in use is calculated to be $240 based on the expected future cash flow. So you are required, one, calculate the carrying amount of the machine as of December 31st before considering the impairment. So remember we said the impairment here, or the carrying amount, it is the cost minus accumulated depreciation. Determine the recoverable amount of the machine. Again, we say the recoverable amount of the machine, it is the higher of the fair value less cost of disposal or the value in use. Calculate the impairment loss, if any. So again, we said the impairment, it is the carrying amount minus the recoverable amount. Prepare the journal entry to recognize the impairment loss. So if there will be any impairment loss, again, remember, we said you debit the P&L and you credit the balance sheet. So let's see the example, the work solution here. So we start with the carrying amount. So carrying amount, again, we said it is accumulated depreciation minus accumulated depreciation minus, it is the cost minus accumulated depreciation. So the machine was purchased on 1st January 2021 for shillings $500,000 and a useful life of 10 years. Depreciation per year will be 500,000 divided by 10, which is 50,000, because this is on a straight line basis. So then depreciation for the 3 year, that is the year 2021 to 2023, when the impairment happened, yeah, it is 50,000 times 3, which will give you 150. So the carrying amount will be cost minus accumulated depreciation, which is $350. Hope that is clear. Then we have the recoverable amount. The recoverable amount, we said again, it is a higher of fair value less cost to sell, which is 200,000, which we have already been given, and the value in use 240 we have already been given. So the higher of, so we pick the higher of, which is 240. Then we have the impairment loss. We said it is the carrying amount minus the recoverable amount. So here the carrying amount is 350, recoverable amount is 240, and therefore the impairment loss is 110. How are you going to record this? You debit the impairment loss, that is in the income statement, credit the machinery, that is the balance sheet. Okay. So we have a class activity here. I would want us to do this and submit it in form of an assignment. Okay. So let us now go to the concept of the present value in this same concept. So the present value is the current worth of a future sum of money or stream of cash flow discounted at a specific rate of return. It reflects the principle that a shillings today is worth more than a shillings in future because of its earning potential. In impairment testing at IS 36, the present value is used to estimate the value in use of an asset, that is, the discounted value of the future cash flow the asset is expected to generate. So the concept is that the present value, it is what it is. Let's say you're looking at 10 years, yeah, 10 years. So how much will be 1,000 be worth in 10 years, but today. So we are pulling 10 years to today and get the value, but of course we are going to use the discount rate. So let's see this one here. The formula for the present value is this. So we normally say that the present value is equal to future value. That is the amount in 10 years. 1,000, how much 1,000 will be in 10 years? That is the future value. You divide it by 1 plus R, then number of years. R is the discount rate. Example, XYZ Limited own a piece of machinery that has been in use for several years. As of December 31st, 2023, the carrying amount of the machinery is $1.2 million. Due to changes in technology, the future cash flow expected to be generated by the machinery has significantly decreased. The company estimated the following cash flow over the remaining useful life of the asset. So these are the cash flows that we have. The company also estimated that the fair value of the machinery less cost to sell is 800,000. The discount rate for the present value calculations is 8%. You are required one, calculate the recoverable amount of the machinery as of December 31st, 2023, using both the fair value less cost to sell and the value in use. 2, determine if an impairment loss need to be recognized, and if so, the amount of the impairment loss. 3, explain how the impairment loss will be reported in the financial statement, including the specific line item that will be affected in the income statement and the balance sheet. So let us go to the solution. So solution. So now, number one, you need to calculate the recoverable amount. So remember we said the recoverable amount, it is the higher of value, fair value less cost to sell or disposal, and the value in use. So the fair value is estimated at we have been given this. So we have already been given this. The fair value is this amount. Since no cost to sell are specific, we assume they are 0. So the fair value less cost to sell or disposal is this one here. So cost of selling is, for example, there might be brokerage fee, etc., etc. So this is the fair value less cost to sell. Then let us get the value in use. So the value in use, so we get the present value of these cash flows that you can see here. The one from 2024, 35, 36, 37, 28. So we are going to use this formula here. Present value is equals to future value or cash flow 1. You divide it by 1 plus R plus cash flow 2. You divide it by 1 plus R until you get the last one. So let us do this one practically. So doing this practically, I don't know, for some reason I'm missing this. So you are going to get all these all these cash flows. Yeah. So the moment you do this, you are going to get. So you're going to get the carrying amount. We have this one. The fair value, we have this one. So you're going to get the value in use of 853,639. That is the value in use that you're going to get. I think I'll be able to put this one in the slide. But using this formula, you can be able to get this amount here. So since the carrying amount is 1.2, is higher than the recoverable amount, then you get the impairment losses 1.2 minus 853, which is 346, 361. So that is how we get the cash flow. But for this particular one, you just come here, say PV is equals to, so you have 2024, you put 250, you divide it by 1 plus R into 1. R is 80%, plus 250, you divide it by 1, plus R is 80% into bracket 2. The other one is 200,000 all over 1 plus R is 80% into bracket 3 years. Then the other one will be, so this is 1 year, 2 year, 3 year, 4 year, 5 years. But all of them, you have the cash flow 1 plus R is the discounted, which is 80%, and the number of years. So the first one for 2024 is 1 year, 2 year, 3 year, 4 year, 5 years. So once you do that, you are going to get this amount here. So, and then you compare between the fair value and the value in use. So you choose whichever is higher, and in this case, the value in use is higher, which is 853. So that means you get 1.2 minus that to get 346. So an impairment of loss should be recognized. Okay. So so we have another. Is this another example? This is example 2. Yes, present value. And so that is the example that we have already done. Yeah, we have another example here. So now this one, this is not an example. So this one, I would like us to do it again in form of an assignment, but it is the same concept. We just use the same concept as the previous example to come up with all this working. So please do this an assignment and submit it before our next class. Otherwise, thank you and have a good day. Let us continue to connect on our usual platform.